today I'm sitting down with James Tansey from the University of British Columbia. So James, you've been looking at impact investment. What is that, and what are some of the latest trends in impact investment?
Impact investing is an emerging field, and it comes out of, in many ways, the failure of traditional philanthropy and aid to address some of the largest social and environmental problems that we face as a society, both in developed economies and in developing economies. And it's based on a couple of premises. One is that you can mobilize far more capital if you have a private investment model that targets financial returns, but also social and environmental returns. So that's part of the issue. Part of the problem is fixing what's not working with traditional development aid. And the second part of it is the belief that an investment-based approach through some form of corporate structure or enterprise functionally can be more effective than just giving away grants and aid and donations.
So the people are they looking first for return on investment, or are they looking for social impact and then a return on their investment?
So it's a good question, and we've just finishing a report that separates out investors who look at market rates of return and investors who are looking at below market rates of return. And so the first thing we did is clarify what market rate of return actually means. The rhetoric of the fund manager is that's 15 to 20%. In practice, it's typically 7 or 8% in traditional commercial funds. Secondly, what we found is that the investors into below market rate of return projects were comfortable making a negative return in some cases, or 0 to 5% IRR in the best cases. And when we queried why that was, the recognition was that in traditional philanthropy, when you give the money away and you get a tax credit, your IRR is negative 70% or more, depending on the tax rates. At least with impact investing, if they're recapitalizing and getting their money back, the money is going further, it's being used again, it's building a base. So you really see below market with a strong emphasis on social and environmental benefits, who are comfortable with recapitalization or even a smaller loss. And then finance first, which has been dominated by clean tech type investments in microfinance investments, where they want to do good, quite intentionally want to do good, but are looking for, at the outset, 15 to 20%. In practice, are typically getting 5 to 8% returns.